We stand at a crossroads in monetary history. Central banks around the world are engaged in the largest experiment with fiat currency the world has ever seen. Money supply expansion that would have been unthinkable 2 decades ago is now routine. Policy. Government debt has reached levels that cannot possibly be repaid in real terms, and in response to this monetary chaos, two competing narratives have emerged about how individuals should asset might built on collective belief rather than intrinsic economic properties. Before the advocates of digital currency dismiss this argument, let me be clear. I understand the appeal of Bitcoin. I understand the frustration with central banking. I understand the desire for a monetary system outside government control. These are legitimate concerns that deserve serious consideration. But understanding the problem correctly doesn't mean every proposed solution actually solves it. And when we're talking about protecting life savings against currency collapse, we need to be brutally honest about what works and what might simply be another bubble inflated by the very easy money policies we're trying to escape. Let's start with first principles. What is money? Not what do we use as money, not what protect their wealth. The ancient answer of gold and the modern promise of Bitcoin. Tonight, I'm going to make a case that may be unpopular in certain circles, but it's grounded in economic theory, historical precedent, and an unflinching look at what money actually is. The case is this: gold remains the superior store of value and inflation hedge, while Bitcoin, despite its technological innovation and passionate following, is fundamentally a speculative. Governments declare to be money, but what is money in its essential economic function? Money is a medium of exchange, a unit of account, and most critically for our discussion tonight, a store of value. For something to store value effectively across time, it must have certain properties. It must be scarce, durable, recognizable, divisible, and broadly accepted. Throughout human history, various commodities have served this function, but gold emerged as the predominant form of money across virtually every civilization for specific, rational reasons. Gold is elementally scarce. There is a finite amount of it in the Earth's crust. The annual mining production adds roughly 1 to 2% to existing above-ground stocks, creating a stock-to-flow ratio that makes gold nearly impossible to debase through increased production. This scarcity isn't artificial or programmed. It's a physical reality of our universe. You cannot print gold. You cannot create it through computer code. You cannot vote to increase its supply. This fundamental scarcity is what gives gold its monetary properties. Gold is also completely inert. It doesn't corrode, rust, or decay. A gold coin buried 2,000 years ago is chemically identical to one minted yesterday. This durability across time is essential for storing value across generations. Gold held its purchasing power through the fall of Rome, through the Middle Ages, through every empire and currency that has risen and fallen. The same cannot be said for any fiat currency in history, all of which eventually return to their intrinsic value, zero. Now consider our current monetary system. The United States left the gold standard completely in 1971, removing the final restraint on money creation. Since that decisive break, the Federal Reserve and other central banks have expanded the money supply at rates that would have been considered criminal debasement in previous eras. The money supply metrics have grown exponentially, while the productive capacity of the economy has grown linearly at best. This gap between money creation and real economic growth, the very definition of inflation, regardless of how government statisticians choose to measure consumer prices. The response from monetary authorities to every crisis has become predictable. Print more money, lower interest rates, expand credit. The 2008 financial crisis brought us quantitative easing, a euphemism for central bank purchase of government debt with newly created money. The pandemic brought us money printing on a scale that dwarfed all previous efforts. We've now normalized fiscal deficits in the trillions of dollars, with no serious plan for repayment and no political will to reduce spending. The only way out of this debt trap is inflation, whether acknowledged openly or implemented through the back door. In this environment, gold has performed exactly as economic theory predicts. Measured against depreciating fiat currencies, gold has preserved purchasing power. While the dollar has lost over 95% of its purchasing power since the Federal Reserve was created in 1913, gold has maintained its value in real terms. An ounce of gold today buys approximately what it bought in ancient Rome when adjusted for the goods and services available in each era. This is what a store of value looks like across centuries. Enter Bitcoin. Created in the wake of the 2008 financial crisis, Bitcoin was explicitly designed as a response to the failures of central banking and fiat currency. Its supply is algorithmically limited to 21 million coins. Its transactions are recorded on a distributed ledger, theoretically making it resistant to government control. Its supporters argue it's digital gold, a superior form of money for the internet age. The comparison to gold is where the argument breaks down under scrutiny. Bitcoin's scarcity is artificial, enforced only by network consensus and the continuation of its specific protocol. There's nothing physically preventing the creation of infinite Bitcoin copies. And indeed, we've seen thousands of alternative cryptocurrencies created using similar or identical technology. The argument that only Bitcoin matters because it was first or has the largest network effect is an argument from popularity, not from intrinsic properties. Gold's scarcity is enforced by physics and chemistry. Bitcoin's scarcity is enforced by code and social consensus. These are not equivalent forms of scarcity. Code can be changed. Network participants can fork the chain. New cryptocurrencies can and do emerge constantly. The scarcity is contingent, not absolute. Moreover, Bitcoin has no intrinsic value whatsoever. Its value is derived entirely from the collective belief that others will accept it in the future. This makes it fundamentally different from gold, which has industrial uses, aesthetic value, and a 5,000-year track record across every human civilization. Gold would have value even if every government on Earth banned it. With Bitcoin, the volatility of Bitcoin exposes its true nature as a speculative asset rather than a store of value. A store of value should be stable in purchasing power terms. Gold experiences fluctuations, certainly, but nothing compared to the extreme volatility of Bitcoin, which can lose or gain 30, 40, 50% of its value in weeks. This volatility makes Bitcoin unsuitable for its claimed primary purpose. You cannot effectively store value in an asset. Might lose half its purchasing power between when you acquire it and when you need to use it. Advocates respond that Bitcoin's volatility will decrease as adoption increases. Perhaps, but this argument concedes that Bitcoin today is not an effective store of value and relies on speculation about future adoption. You're being asked to trust that enough other people will eventually share the belief that gives Bitcoin value. This is the definition of a confidence game. And while it may continue working as long as confidence persists, it's not the same as owning an asset with intrinsic properties that ensure value. The technological risks of Bitcoin are also understated by its proponents. The security of the network depends on continued mining, which requires enormous energy expenditure. If Bitcoin's price falls substantially, mining becomes unprofitable, hash rate declines, and the network becomes more vulnerable to attack. The entire system, internet connectivity, and the continued functioning of a complex technological infrastructure. Gold requires none of this. It exists, it persists. It needs no network, no electricity, no maintenance. There are also the risks we cannot fully anticipate. Quantum computing could potentially break the cryptographic foundations of Bitcoin. Regulatory crackdowns could severely restrict its usability and, therefore, its value. Technological alternatives could emerge that make Bitcoin-specific implementation obsolete. These are not far-fetched scenarios. They're genuine risks that must be weighed when considering whether to store your wealth in a 15-year-old technology. Furthermore, the narrative that Bitcoin is outside government control is only partially true and becoming less true over time. Governments can and do regulate the on-ramps and off-ramps between Bitcoin and fiat currency. They can tax Bitcoin transactions, require reporting, and make practical usage difficult even if they cannot directly seize coins stored in properly secured private wallets. The idea that Bitcoin represents complete financial sovereignty is more theoretical than practical for most users. The comparison to gold becomes even more stark when we consider crisis scenarios. In a genuine currency collapse or systemic financial crisis, what do you want to own? An asset that has been recognized as valuable for 5 millennia and requires no technology to verify or use, or a digital entry on a distributed ledger that requires electricity, internet, specialized knowledge, and counterparty trust in exchanges to convert to usable goods and services. Gold is liquid in every country on Earth. It can be sold, traded, or used as collateral without any technological intermediary. In a true crisis, when trust in financial institutions evaporates and systems fail, physical gold is a tangible asset you control completely. Bitcoin, for all its cryptographic security, still requires a functioning technological infrastructure and other people willing to accept it. The psychological appeal of Bitcoin is understandable. It feels modern, technological, revolutionary. It appeals to a libertarian desire to build systems outside government control. It offers the possibility of enormous returns if adoption continues to grow. These are powerful motivations, but they are not the same as sound economic reasoning about what constitutes reliable money. The enormous price appreciation of Bitcoin over its relatively short existence has created a generation of advocates whose belief in the technology is inseparable from their personal financial gains. This creates confirmation bias and makes objective analysis difficult. Every price increase is hailed as validation, while every crash is dismissed as temporary volatility or an opportunity to buy the dip. This is the language of speculation, not of money. Sound money theory, particularly from the Austrian School of Economics, emphasizes that money emerges through market processes as a commodity chosen for its superior properties as a medium of exchange. Gold became money because it was the commodity best suited for the role. Bitcoin is attempting to become money through technological force and network effects, but it lacks the intrinsic properties that made gold successful. It is, in essence, fiat currency without the government. sustained entirely by collective belief. The irony is that many Bitcoin advocates correctly identify the problems with fiat currency, government deficit spending, and central bank money printing, but then embrace a solution that shares many of the same flaws. Both fiat currency and Bitcoin derive their value from collective acceptance rather than intrinsic worth. Both require faith in the continuation of the system. The difference is that fiat currency is backed by governments with taxation power and legal tender laws, while Bitcoin is backed only by belief in its protocol and future adoption. This doesn't mean Bitcoin has no use case or value as a technology for transferring value across borders, as a hedge against specific types of government restrictions, as a speculative asset in a diversified portfolio. Bitcoin may have merit. But these use cases are different from being sound money or a reliable store of value equivalent to gold. The fundamental question each person must answer is this: if you're trying to protect your wealth against currency debasement and monetary chaos, do you want to own an asset with 5,000 years of history as money, with intrinsic properties that ensure scarcity and durability, recognized and valued across every culture and generation? Or do you want to own a 15-year-old technology whose value depends on continued network adoption, functioning technological infrastructure, and collective belief in its protocol? For serious wealth preservation, for genuine protection against the monetary recklessness of our central banks and governments, gold remains the superior choice. It is not a speculation on future adoption. It is not dependent on technology continuing to function. It is not vulnerable to regulatory crackdown or quantum computing. It simply is what it has always been: real money, sound money, the money that has outlasted every empire and every fiat currency ever created. The coming decades will likely see continued monetary instability, persistent inflation regardless of official measurements, and increasing desperation from central banks unable to extricate themselves from the debt traps they've created. In this environment, owning gold is not a bet that things will get worse. It's simply insurance that has already proven its value across every previous currency crisis in human history. Bitcoin may survive and even thrive. It may become a widely accepted part of the financial system. It may generate extraordinary returns for those willing to accept its risks. But when the question is protecting your wealth against the collapse of fiat currency, there is no substitute for the asset that has fulfilled this role for 5 millennia and will continue to do so long after today's technologies are obsolete. Gold is not an investment in future possibilities. It is preservation of present value. And in a world of monetary chaos, preservation is the first priority.